Over to Rajiv Jain now. He's Chief Investment Officer with Wantable Asset Management. Wantable is one of the biggest investor or one of the biggest portfolio investor in Indian equities. And some of the core holdings, they include names like ITC, HUL, HDFC, and then TCS. They own really a lot of quality end of the market. Rajiv, of course, is a long-term India bull, and in terms of his allocations, they are one of the highest in India. Rajiv, fantastic to have you back on ET Now. Thank you for joining us. The big question, Rajiv, is that have you altered your India strategy in last 1 month when you visited India? And have you reworked your allocations and booked profits in your holdings?
No, I mean, frankly, there was no change. I mean, I think if you look at our current positioning, we have significant exposure to 3-4 core areas, right? The first one is financials, the private sector banks, the HDFC, HDFC Bank, and so on and so forth. Then we have a couple of pharmaceuticals, obviously consumer staples, and a small portion in the IT services. In fact, we feel that the best opportunity today is more on in the financial services. That's where the biggest damage has been, especially the names that we own. Not necessarily making a big bull case on public sector banks or anything. We don't have any exposure there. So there was no really change from a couple of companies we met. So it wasn't really a big change of perception.
Rajiv, hi, morning. At 12 times FY14 earnings and a 16% fall in the rupee, does India not become a compelling buy? And do you see a strong rebound from here? Or do you think investors will give more weightage to macro risks than favorable valuations at this point?
Well, I think if you look at emerging markets in general, everything has sort of been compressed, right? Multiples have come in quite a bit. So if you look at our global portfolio, just about a year and a half, 2 years ago, we actually cut back our emerging market exposure in the global portfolio significantly. We had over 20% plus. It went down to, I believe, 7-8%. It's actually beginning to go up in a whole bunch of different areas. So because the valuations are good. So coming to India, I think India, this is fascinating, because if you look at last 20-25 years, this sell-off has started when the multiples were pretty low compared to historic norms. In fact, valuations today are lower, or actually the valuations, the peak of this sort of sell-off were lower than the trough of the 2008, right? So, and that's why I feel pretty comfortable that the valuations are attractive enough for us, especially from in the quality space. Now, clearly not everything has been hit. Quality has held up better, but that's how quality is supposed to behave, because people say, hasn't quality outperformed? Well, the question is, how do you define quality, right? I mean, quality is defined by how well the business holds up and how well the management behaves during stressful times. So I think it's from our perspective, we like a bunch of things. So our exposure has actually increased over the last few weeks.
Rajiv, in the past you've stated that a 5 to 6% growth is a good enough and a sustainable and a healthy growth for a market like India, for an economy like India. How do you respond to the deep disappointment global investors currently are showing for the India growth story?
Well, I think it sort of comes back to the point I just made, that I don't think so any serious money would be invested in India because the GDP growth is 7% or 4.5%. Okay, and that is why you haven't seen massive outflows on the equity side, because people keep saying, well, there's macro problems, so there should be outflows. Well, yes and no, because if you see where the money has gone, it has gone into certain corporates. You take out, let's say, top 20 corporates in India. I would argue that India would have gotten probably 10% of the flows that they have seen over the last 2-3 years. So it's been a very specific bottom-up story rather than a big macro call. So I mean, from our perspective, actually, one could be optimistic that hopefully something comes out of this crisis, because as the saying goes, never waste a crisis. So I think this crisis, hopefully something good should come out of it, because arguably, between 2003 and 2010, the regulators / government / some of the corporates got very, very complacent. And I think this complacency has been shattered, and that complacency was judged to be on some sort of India story. And as I said, I don't understand what the India story is. There's massive amount of capital inflows, which sort of inflated the growth, and hence you got inflation. And now you're coming back to normal trajectory of 4 to 5% growth. 5 to 6 in good times, 4 to 5 in bad times.
Rajiv, where are we when it comes to the banking story? Because the damage to the banking pack has been quite incredible.
I think the way you look at it is that you have to sort of value them on a through the cycle basis, right? So even if you do some sort of sensitivity analysis and say, well, the NPLs are going to go up by X or Y, these stocks still look pretty attractive. And I'm talking about specific names. I'm not making a case for each and every financial. So if you look at, for example, HDFC Bank, would they be better off because of crisis or not? And we would argue that they would be better off than on a relative basis, right? But on an absolute basis, they will be worse off too. Same like ICICI, same like Axis, or HDFC Bank, or Housing Development Finance Corporation. But on the valuations, things are a heck of a lot better. So 5 years ago, when everyone was excited about some of these names, they were selling at very high multiples. So I think to what I'm saying is that I'm not disagreeing with what you're talking about in terms of deteriorating the fundamentals. But the fundamentals are not deteriorating as rapidly as the market price have corrected. And the correction has been happening over the last 5-6 years. As I said, if you look at HDFC Bank, their earnings are probably up 4x over the last 5-6 years. Right? 4 times. Where's the stock? The stock is, in dollar terms, pretty much trading where it was. So it is up a little bit. But there has been significant multiple compression. So if the outlook was good, do you think the HDFC Bank would be trading at these levels? Of course not. So what we are saying is that, yes, there are problems, but on 3 to 5 year basis, the valuations are more than enough attractive for us to sort of own them or incrementally add to them. And as I said, we've sort of added incrementally in the whole bunch of these names over the last couple of weeks.
So, Rajiv, are you making a case that there is time to put money to work into HDFC Bank, the likes of ICICI Bank and Kotak Mahindra Bank, the good quality private guys?
Well, I think again, without specifically naming 1 or 2 names, I mean, if you look at our holdings, what we own, we have not sold anything. We feel that that they still offer very good longer-term growth opportunity, but there's quite a bit of pessimism being priced in these names. Will these banks would have to take a haircut in terms of delinquencies going up? Why not? But would the franchise be around and in a better shape in 5 years? We think so. So, I mean, there's a reason why these stocks are trading at these multiples, and they can easily go lower, by the way. So I'm not making a call that, gee, they can't go lower. But our question is, well, even if, let's say, HDFC goes down by 20% from here, right, over the next 2 months, does it change our view? Not really.